Finance is more than just numbers and charts. It's the foundation of how individuals, businesses, and nations make decisions, allocate resources, and build wealth. In this comprehensive guide, we'll explore the essential concepts of finance, from the history of money to modern-day investment strategies. Whether you're a beginner or looking to deepen your financial knowledge, this text will serve as your roadmap to mastering finance in today's world. Chapter 1. What is finance? Finance is the science of managing money. It encompasses personal finance, corporate finance, and public finance. At its core, finance involves the allocation of assets and liabilities over time under conditions of certainty and uncertainty. It seeks to answer fundamental questions like, how do I invest my money? How do companies raise capital? How do governments fund their operations? The field is divided into three main areas: personal finance, managing individual or household finances; budgeting, saving, investing, insurance, and retirement planning. Corporate finance, how businesses manage their capital structure, funding, and investment decisions. Public finance, government revenue and expenditure, including taxation and debt issuance. Understanding finance empowers people to make informed decisions, avoid unnecessary risk, and grow their assets over time. Chapter 2. The history of money. Before finance, there was barter, trading goods and services directly. This system had limitations, leading to the creation of money as a medium of exchange, a store of value, and a unit of account. Ancient civilizations used commodities like salt, cattle, or grain as money. Eventually, societies developed coinage systems using metals like gold and silver. Paper money came next, backed by physical reserves. Modern money is mostly digital, stored in bank accounts and moved electronically. Central banks manage money supply and control inflation through monetary policy. Chapter 3. The banking system. Banks are financial institutions that accept deposits and provide loans. They're the backbone of the modern financial system. Types of banks. Retail banks serve individuals with checking accounts, savings, and loans. Commercial banks work with businesses. Investment banks help companies raise capital through issuing stocks and bonds. Central banks regulate the monetary system, control inflation, and maintain financial stability, e.g., the Federal Reserve, European Central Bank. Banks use a fractional reserve system. They keep a fraction of deposits in reserve and loan out the rest, effectively creating money. Chapter 4. Personal finance essentials. Managing your personal finances is the first step toward financial independence. Key areas include budgeting, track income and expenses. Live below your means. Saving, build an emergency fund. Aim for 3-6 months of living expenses. Debt management, avoid high-interest debt. Pay off credit cards monthly. Insurance, protect yourself with health, life, auto, and property insurance. Retirement planning, start early. Contribute to retirement accounts like 401(k)s or IRAs. Investing, grow wealth through stocks, bonds, real estate, and other assets. Financial literacy is about making informed decisions and planning for the future. Chapter 5. The stock market. The stock market allows investors to buy shares of public companies. It's a key driver of wealth creation. Types of stocks. Common stock, voting rights, dividends. Preferred stock, fixed dividends, no voting rights. How stocks work. When you buy a stock, you own a piece of that company. If the company grows, your shares become more valuable. Major stock exchanges. New York Stock Exchange, NYSE. Nasdaq London Stock Exchange, LSE. Key metrics. Price to earnings, P/E, ratio. Dividend yield. Market capitalization. Investing in stocks requires research, patience, and risk management. Chapter 6. Bonds and fixed income investment. Bonds are debt instruments. When you buy a bond, you're lending money to a government or corporation in exchange for regular interest payments and the return of principal at maturity. Types of bonds. Government bonds, e.g., U.S. Treasury bonds. Corporate bonds. Municipal bonds. Bonds are generally less risky than stocks but offer lower returns. They're useful for income and portfolio diversification. Key concepts. Coupon rate. Maturity date. Yield to maturity, YTM. Chapter 7. Mutual funds and ETFs. Mutual funds pool money from many investors to invest in a diversified portfolio of assets. They're managed by professionals. Exchange-traded funds, ETFs, are similar but trade like stocks on exchanges. Advantages: diversification, professional management, accessibility. Investors should consider expense ratios, fund objectives, and historical performance. Chapter 8. Real estate and alternative investments. Real estate can generate income and appreciate over time. Investors earn through rental income and property value growth. Other alternative investments include commodities, gold, oil, hedge funds, private equity, cryptocurrencies. These assets often have higher risk but can improve diversification and potential returns. Chapter 9. Risk management and financial planning. Risk is an unavoidable part of investing. Effective financial planning involves assessing and managing risk. Types of risk: market risk, credit risk, inflation risk, liquidity risk. Strategies to manage risk: diversification, asset allocation, regular rebalancing. Create a financial plan with clear goals, timelines, and contingency plans. Chapter 10. The role of governments and central banks. Governments influence the economy through fiscal policy, taxing and spending, and monetary policy, controlling money supply. Central banks use tools like interest rate adjustments, open market operations, reserve requirements during crises, e.g., 2008 financial crisis, COVID-19. Central banks inject liquidity and stabilize markets. Chapter 11. The rise of Fintech. Financial technology, Fintech, is transforming banking, investing, and payments. Examples: digital wallets, PayPal, Apple Pay, robo-advisors, Betterment, Wealthfront, peer-to-peer lending, Lending Club, blockchain and cryptocurrencies. Fintech improves accessibility, reduces costs, and increases transparency, but also raises regulatory challenges. Chapter 12. Building wealth and achieving financial freedom. Wealth is built through discipline, knowledge, and long-term planning. Follow these steps. Live below your means. Save and invest consistently. Avoid bad debt. Increase your income. Keep learning. Financial freedom means having enough assets to cover your expenses without working actively. It provides time, flexibility, and peace of mind. Finance is a vast and evolving field that affects every aspect of our lives. By understanding financial principles, you can make smarter decisions, build wealth, and secure a better future. Whether you're managing your own money, investing for retirement, or launching a business, this guide gives you the foundation you need to succeed. Stay curious. Stay disciplined. And remember, your financial journey is a marathon, not a sprint. Thank you for watching this video and taking the time to learn about finance. If you found this guide helpful, don't forget to like, share, and subscribe for more insightful content. Your support allows us to continue creating valuable educational videos that empower people around the world. Remember, every financial decision you make today shapes your future tomorrow. Stay committed, stay informed, and take control of your financial destiny. See you in the next video.